We got wealth management piece.
So this one, it says, the title is 2023 is unlikely to bring a large wave of CRE distress. It is a conversation with the chief investment officer of Walker & Dunlop. His name is Marcus Dooley. And this is, it's a lot of the stuff that we've been talking about, a lot of things, that we have noticed ourselves. My question is, how much will this situation characterize the market, and more generally, what can we expect in terms of sales activity in 2023? And Marcus Dooley does not think that distressed properties will be a major factor in the CRE markets. And I think he sagely notes, he says, we're going through conference season, and as people transact because they have to transact, they will set the market. It will be comps for appraisers, and we're seeing it now. So a lot of this uncertainty could dissipate following the discussions and negotiations at conferences like NMHC, which is, you're headed there. It's the multifamily specific conference headed next week in Las Vegas.
Reporting live next week, man.
Oh, good.
From NMHC, by the way.
All right,
I'm bringing. We need to actually. I need to talk to. We're going to bring a mic and some gear, because we're not only going to do the great report with live. I've got some other report videos to do for like properties, but maybe live on the floor.
All right, awesome. Perfect.
I don't know. Continue.
And Julius is quite clear-eyed about the perspective of buyers in the situation. Yes, the title is that it's unlikely to bring CRE distress, but he's makes some pretty forceful points from that perspective of a buyer. He says that buyers won't buy at prices where they will not hit their targeted returns. Ultimately, what will happen, and what has happened, is cap rates are adjusting. As an investor, I cannot buy a property and take a lower return. I think that really cuts through a lot of the uncertainty there.
With online,
with significant implications, I think, that put some force behind Dooley's statement. As we've noted before, these buyers and investors have specific return criteria. If the math doesn't work, they're not going to be able to buy. That's kind of the buyer's side. And if I'm the seller, I'm thinking, well, what if this return criteria is unreasonable? Can't these cheapskate buyers just lower their return threshold? And I think that the implication from Julie's statement is that actually these buyers do have reasonable return criteria, and sellers are going to have to accept lower property values and higher prices. I think that part of the force that I'm putting on Dooley's words here is me calling to mind the perspective of a seller who's reading some of the projections that property valuations could go down 20 to 30% this year, or they already are down significantly. And even though they might have seen a 40% increase in the past 3 years, it's really hard to give up that last 20. Even if their net is 20% extra, they feel like someone's reaching inside their wallet and taking that 20% away. And they want all that 40.
Yeah, especially they've told their investors.
Yeah, exactly. And I remember, as a home buyer, there was something that in part of negotiations, there was something that we were going to try to get a little bit cheaper of the house. And I was like, the way they see it is not going to be like this theoretical price is going down. They're going to see it as us taking money from them.
Yeah. Oh, yeah.
And so it really hurts to, I think that right now it hurts to think that for sellers, and the pain's got to go the other way. They've got to start to rationalize these losses, and nothing's easier to do that than simple math. But sometimes math isn't so simple. So
yeah, that's true. And so this comes from Walker Dunlop, or Marcus Dooley is works for Walker Dunlop, and Walker Dunlop is they're in the business of originating loans. They're they have a variety of commercial real estate services, from investment services to capital markets, a lot of different stuff. And so obviously they want the multifamily market to do well, but they're usually pretty straight shooters.
Yeah.
And we work with Walker and Dunlop pretty closely. But one thing that I asked Paul Fiorella this as well about this exact question of loans coming due, and what I was wondering is how accommodating are banks going to be? And how willing are banks and lenders going to be with borrowers who are in these situations? Because banks don't. As much as I'll take the keys, banks don't want the keys. They don't want to manage properties. They learned that back in 2008 during the great financial crisis. We saw in the pandemic, there's a kind of a precedent now for, kind of being nice and easy and it's a hard time. We had forbearance. We had all kinds of forgiveness and eviction moratoriums and things like that. Now we don't have those exact things going on just yet, but this idea of, intervention, whether that is, private intervention from the lenders themselves being like, hey, look, we're just going to work with you.
Yeah.
And I think most will want to if there's good faith efforts being made by the owners. If not, then that's a different story. Then also from the federal government, FHA, Fannie Mae, Freddie Mac, HUD, they're doing, about, I think, over 50% of all the loans in the multifamily industry. They may even get some, straight up mandates.
Yeah, and Marcus Dooley notes some of that stuff that he said too, is like there is going to be opportunity for people to recapitalize, and selling is going to be a little bit of a last resort for a lot of people. So there's a lot of options, and selling it to a hungry buyer is just one of them.
Yeah, there's going to be some pretty high yielding mezz debt, I think, that's out there. People are going to put some additional debt on these properties. That's going to be in a second, subordinate position to the first loan, but like they're going to be charging some pretty rich interest, and so I think there's going to be a lot of investors for that. Paul also mentioned that, and Marcus is also mentioning that there's going to be a lot of pref equity in general has come into vogue the past 8 months or so, because with LTVs getting squeezed and harder to get their cash flows, buyers are bringing on some pref equity to juice the common equity and fill up the capital stack. And so, if that example we talked about earlier of, hey, I need to bring $3 million extra dollars to the closing table. Maybe they can get some pref equity that fills that spot. Maybe it's a JV equity that completely recapitalizes the deal at some very aggressive terms, or maybe they can get some mezz debt if the first position lender is good with that.
Yeah. So there are options. So this is the kind of, and I do seem to think this seems like the realistic option. Now, it's not the only view of next year in terms of property sales and distressed property sales specifically, because there's this article from Globe Street that says a lot more likely. It says that expiring interest rate caps are going to fuel distressed property sales, and in the Globe Street article, I think it's a pretty good counterpoint actually to the article to the comments from Marcus Dooley. I'm really highlighting rather than downplaying this possibility. And as support for this claim, the Globe Street author writes that in 2019, the Mortgage Bankers Association estimated that up to 1/3 of all commercial property debt was floating rate, with most lenders requiring that borrowers hedge against an increase in the borrowing costs. 2019 conditions are certainly different from the last 3 years, but you could make a case that the ratio of floating rate debt increased during the pandemic. Sure, it could have decreased. Even if it's the same, though, that's a pretty big chunk. 30%. What does it say? A third of all. So that's a lot.
Yeah, that was in 2019.
Yeah,
and now there's more in multifamily because of FHA and the agencies. There's more fixed rate available in multifamily than other commercial rate asset classes. However, there's always been a lot of floating debt, and man, in the pandemic, there was so much bridge debt, and there was people were saying, I remember all the time people saying they're like, our interest rates aren't going up anytime soon. Yeah. It didn't seem like they were. It was like free money for everyone forever. And so a lot of people were saying, hey, we'll figure it out. There's so much rent growth. Like, hey, we're locking in, and because your rate would be so low if you took some of those floating rate loans. And when the interest rate caps were cheap back in prior to March of 2022, it was a great deal. You'd be able to buy a cap that you could afford. You have a rate in the 2s, a bunch of interest only. Like, sounds like a deal. And one of the reasons is because the prepayments are much more flexible in the floating rate. You can get out early without a big prepayment penalty. We're on fixed rate loans. A lot of times there's a steep prepayment penalty that can make selling it early not attractive. But like a lot of these floating rate loans, it's like a 1% prepayment penalty after a certain time. And if that's the case, then you have more flexibility. You can sell it in the next year or two, because what a lot of owners experienced during 2021 and early 2022 is that they had an asset that was very valuable. It had appreciated considerably, but the prepayment penalty was so high they couldn't do anything. They couldn't refinance. they couldn't really sell it. I mean, they could, but a lot of their profits were being eaten up by these prepayments. I mean, it could be 10% prepayment penalty.
Yeah.
It can be steep, and so they're maybe we'll do it, but maybe we'll wait. And so a lot of people were like, there's too much risk in the inflexibility of the prepayment penalty. I'll float it because then in a year or 2 years, if it bumps up in value again, I can flip out. I can get a 50% IRR, give a 1.75 or 2x to my investors, do it again, and just keep rocking and rolling. But the music's kind of got slowed down, if not stopped, so that doesn't really work anymore. We switched on. We switched pretty early. I mean, we historically haven't done a bunch of floating rate debt. We've done some bridge loans for a lot of value add stuff. But yeah, we started shifting away from that March last year because we just knew it was close up.
So it's either going to be a flood of distressed properties entering the market, or maybe more of a trickle.
The flood of distressed properties makes for a better headline.
Yeah, it is true. So I'd rather be making that thumbnail of an impending flood.
And it's going to be somewhere between. There will be distressed properties. People are going to lose their shirt, but it's not everybody.
Yeah.
In fact, I think it's going to be the exception that does rather than the rule, because it's not like everyone had a bridge loan.
Yeah.
It's not like every property. It's not like every property was sold last year.
Yeah.
Or the last couple of years. And then some of the properties that were put on a bridge loan, they're going to be okay. I mean, we have one property that has a bridge loan on it because we were doing a big value add. We've gone through the value add. We've gotten rents up. So NOI has increased quite a bit, and even our net cash flow has. But our debt service, when we started, we were paying about. When we had a floor. So if there wasn't a floor, we'd be paying like $10,000 a month, but we were paying about $21,000 per month in interest.
Okay.
Now paying, I think, $59,000 a month in interest.
Yeah.
But our NOI went from being in the kind of in the low 50s and 60s K per month. Now we're in like the 90s per month. So we've grown rents and we're in a good spot, and we also have we have so much reserves that we brought on for not only capital expenses but for stuff like this that even if we had to bring cash to the table we could, but we're not going to have to. But there are some folks that don't have an extra couple million sitting here ready to go, or they were unsuccessful in their business plan. Yeah. And they're looking at low NOIs. They're looking at increased debt service that has literally doubled, almost tripled. And that's rough sailing. It's
going to be some important conversations that happen in the next 2 weeks, really. So this is a particularly exciting time.
And like he said, it's conference season. NMHC next week in Las Vegas is going to be. It's going to be. I'm hoping to have some insights to report back to Great Report.
I didn't notice this last year. It wasn't. Yes, there was it's typically the start of the deal season, within him, but it was much more there's MHE.
Everyone's waiting. Last year it was everyone's waiting to launch the deal. It's usually there's a slowdown in deal flow because all the brokers want to go to NMHC and to launch their deals. Yeah. And we would get some previews and stuff, but all the deals get launched at NMHC. Now it's everyone's is going to. I mean. They're going there to see what's going on, and to maintain the relationships and have the conversations. But I've heard rumors that where some brokers would be bringing out dozen plus properties, and it's going to be a couple. Yeah, well, but it's there's only going to be so much in the market, so if someone really wants to buy, there's only going to be so much inventory out there. But are there going to be takers for that inventory at that price? There's a bidding war over just the scraps. Yeah. But it'll be. I mean, last year. I mean, everyone was making so much money they didn't know what to do. And the brokers, they're just crushing volume. The lenders are originating loans. The buyers are not doing. The operators not even doing anything. They're making money. They're refinancing. They're selling their deals for stupid cap rates. And everyone's thinking that they're so smart. And now this year, everyone is going to show up scratching their head. Yeah. And so it's going to be interesting. It's a little bit of groupthink, obviously, when in those types of situations, because everybody wants things to work out all right, but also everyone wants to come off as the most conservative and whatever. But we'll have some good insights to report back.